The election of Donald Trump sparked some major capital movements and big swings in world markets. As Inauguration Day approaches, however, we're starting to see some of these trades unravel and unwind, particularly in the stock market and in the US dollar, following through into related currency markets. Following the US election, there was a lot of pent-up demand, sent capital flowing out of defensive havens where it had been parked into the US dollar and also into the US stock market. There was a lot of anticipation that Trump's policies would be bullish for the U.S. economy, and that sent everything screaming upward. It also sparked expectations of a large number of Fed rate hike increases in 2017. However, as we moved into this year, we were getting to the point where Trump was getting priced to perfection, where U.S. markets were getting really overextended, and we were starting to get into what could be what I call the hammock effect, where you have a sag in the middle, where you had this huge front running of U.S. markets anticipating Trump. However, the benefits of Trump's policies in infrastructure spending, changing regulations, tax changes, those might not actually hit corporate earnings in the economies until the end of 2017 or even 2018. So you had the potential for this sag in the middle, and you're starting to hit that now as Inauguration Day approaches. Markets are starting to recognize Trump had been priced to perfection, that there's a potential for bumps along the way, for opposition, that trade talk and moves could spark opposition and even retaliation from other countries, that things aren't all going to be roses and going forward. So anyways, there's still uncertainty, and that's starting to find its way into the U.S. market now. Even today, Donald Trump himself has figured that out, because he started talking about the U.S. dollar being too high. The high dollar actually would crimp his program because it hurts U.S. exports, it hurts U.S. earnings when they repatriate overseas earnings. So in fact, the high dollar is actually a problem for his plan. And we're starting to see that now. He's starting to say the dollar was too high, it should come lower. He's blaming China for it, but in reality, it's a whole combination of factors. But on top of that, today we had New York Fed President Dudley out saying that the Fed's not likely to get materially more hawkish. So the market may actually have priced in a more hawkish Fed than we're actually going to get. We were looking at, not that long ago, the market was pricing in 4 or 5 rate hikes this year, where 2 or 3 is more likely, and that's up from 1 last year. So already there was room for the U.S. dollar to come back. It's starting to come back. Room for U.S. stocks to have a correction. We're starting to see that as well. Let's look at the market action here. Well, we'll start with the U.S. market, where we're seeing with the Dow this huge explosive rally. This was the initial post-election phase. Then we had a second phase in December, where what happened was there was all this capital sitting on the sidelines. Portfolio managers got into early December and went, oh no, the market's going to be up, and I'm going to be showing a huge cash balance and underperform. Boom, another round of capital got plowed into the market, took the Dow up to 20,000. It's been unable to get through. It's run into a real wall of resistance. Meanwhile, look at this RSI way overbought, steady downtrend for over a month now, upward momentum fading, correction potential increasing, downtrend potential increasing. So far, we're still bouncing around between 19,700 and 20,000, but these lower highs suggest we're starting to get more distribution in U.S. stocks. Going over to the U.S. dollar now, where we're seeing it had a huge rally. It had been leveled off here in December and is starting to roll back down. And look at this big red candle now. Now we're starting to see the downward pressure really come in. The RSI had already drifted under 50 back here on this red candle, and that first signal. Look at this. This is actually a bearish engulfing day. Look at that, where we had a higher and then pushed lower, and now we're seeing another big breakaway to the downside for the U.S. dollar. The U.S. dollar, in its relentless rally, had positively steamrolled other currencies. These are now starting to bounce back. Let's take a look at gold. Gold, for example, bottomed out here around 1120 in mid-December. Look at this steady march upward. Look at that very, very strong underlying accumulation, breaking the 50-day, taking over Fibonacci levels. Look at this big rally from hugely oversold conditions, just a steady increase in upward momentum. We're nearing overbought, means at some point we might have to pause a bit, maybe in and around this cluster of Fibonacci levels between 1205 and 1210. Up here is 1230, maybe somewhere in here. But generally speaking, the trend for gold has been becoming increasingly positive. The euro, which also had been crushed, is also on the rebound here. It formed a nice base between 103.60 and 105. It's now breaking out, continuing to work its way upward. It's cleared its 50-day moving average. That's now become support in and around 106. It spiked up to 107. The euro can still recover against the US dollar, although the euro has had mixed action because the euro is underperforming. An even bigger rebound in the pound as Brexit starts to move forward. So when you're looking at euro trading, recognize that it may trade differently against the US dollar, against the pound, and against the yen. So just to note that on the euro, but at least against the US dollar, it's still recovering nicely. Gold RSI is up here and they're overbought. Euro would seem to have room to run since its upward momentum is picking up, but it's not overextended. The last one I just wanted to highlight is dollar yen as well. Now in this case, this is US dollar going up, this is US dollar going down. So since actually we had a double top here at the beginning of January in dollar yen, US dollar has been retreating. This retreat is accelerating. Look at this massively overbought, big negative divergence, and now the downward pressure has been accelerating to the downside, particularly after the RSI. Look at this bounce, tested 50 once, lower high, broke 50, and heading downward from there, and that's accelerating. And look at the acceleration here. 114 was a 23% reversal of this big rally here, and it held for a couple of days. It's given way today. The 50-day average has given way today. This is signaling the start of a new downtrend. There's a test here, 112.35, but this one here, 111 and 25, a 38% retracement of this previous rally as potential support here. This double top rolling over, double top successfully completed, and overall the yen is picking back up as the US dollar starts to turn down. So as we move towards Inauguration Day on Friday, we are definitely starting to see a change in sentiment. The people that had gone in on the election and built all kinds of hopes and dreams into what Trump might do are now starting to run into this hard wall of reality. On Friday, he starts making real decisions. The market goes from speculating on what he could do to reacting what he actually does do. He said an awful lot of things during the campaign about things he was going to do on his first day in office. Let's see what he actually gets to.